Paul is the QQQ Equity Product Strategist for Invesco. Our sponsor spotlights the innovation engine, and I know that the Qs very much ladder up into that. So I'd love to start at the beginning, maybe not March of 1999 beginning, but love a little bit of a refresher on what the Qs are. I think a lot of our audience probably owns them and has exposure to them, but just tell us about QQQ.
Sure. So QQQ is an exchange-traded fund, and it is based on the NASDAQ 100 index. So what that means, it invests in the 100 companies that comprise the NASDAQ 100 index, which is the 100 largest ex financials. You know, through the years, what we've seen QQQ really provide investors is exposure to high growth companies. You know, today it's most notably has exposure to Mag 7 companies, but if we go back a few years, there was high exposure to FanMag. Before that, it was FANG. So through the years, we've seen these highly disruptive and innovative companies make their way into QQQ. And really, what we've seen from these companies is that they've done a fantastic job of really transforming and innovating within the sectors that they're in.
What makes the NASDAQ 100, and by extension, the Qs, a great way to get exposure to the tech sector for investors?
Sure. So the NASDAQ 100 index just celebrated its 40th anniversary this year. QQQ has been around for over 26 years. It really has become a fantastic way for investors ranging from individuals all the way up to sophisticated institutions to gain exposure to the tech sector through the years. It's the second most traded ETF, so a lot of people are using it, as well as being the 5th largest ETF in the world. But I really think the reason why people have been using it through the years is that it really has provided a consistent way, a one-ticker solution, so to speak, to invest in these disruptive companies. And the question that we like to ask ourselves, why is that? Why does it seem that a lot of these NASDAQ 100 companies always seem to be at the center of some of these technologies, obviously, most recently, artificial intelligence? What we've seen is that a lot of these companies spend quite a bit on research and development. So we use that as a way to actually gauge innovation, research and development spending. And we see your average NASDAQ 100 company, an extension QQQ company, outspend your average S&P 500 company when it comes to research and development. But we dive deeper than that as well when we take a look at the patent activity that these sort of companies have. And we see, by extension, the fund through the company's patent portfolios, they give you exposure to things like robotics and big data and cloud computing, these sort of thematic ideas that investors are looking to gain exposure to without having to dive into one specific company.
Diversification, always the name of the game here, and obviously the NASDAQ 100 brings us to conversations about technology specifically, but I'd love to talk about diversification within the Qs, just because I realize it's not purely a tech play.
Yeah, that's a great question, Mike. You did your homework. So, you know, what we've seen through the years is that the tech exposure can range between 50 to 60%, depending, you know, what classification system you're looking at. But obviously that leaves about 30 to 40% to other areas of the overall market. So what we've seen throughout the years is that what we like to say is we get this focus on technologically oriented companies that make their way into the fund because they list on NASDAQ. You know, great examples of this are like Intuitive Surgical or Gilead within the healthcare sector. You also gain exposure to other areas of the market that I think people would be surprised by. We have Costco as one of the larger holding in there, along with PepsiCo, more traditional consumer staple companies. So I think the common theme, though, that we do see is that these companies have been leaders within their industry, not because they've stayed on the business model that have perhaps worked for the previous 20, 30 years, but they constantly are changing to the needs of their consumers and really have delivered from a fundamental basis where we see strong revenue and earnings per share growth.